What you should do with your RSUs. Today, we're breaking down what to do with your RSUs, from taxes to investing to using them as a launchpad for your bigger financial goals. By the end of this video, you'll know how to make the most out of every share and make your RSUs an integral part of your long-term financial plan. Hi, I'm Justin Kuntz, Managing Director of Pacific Wealth Management, helping you make good financial decisions through sound management for a secure future. Let's start with the basics. RSUs, or restricted stock units, are a form of stock compensation companies use to reward employees for staying with the company or hitting specific performance goals. They typically come with either a graded or cliff vesting schedule. Graded vesting is more common and rewards employees gradually while allowing partial sales along the way. Let's say your company gives you 1,000 RSUs with a 4-year vesting schedule. Instead of getting all 1,000 shares at once, you earn a portion every year. Some plans get even more granular. After your first 250 shares might vest, then the remaining 750 might vest in a smaller monthly amount. Cliff vesting, on the other hand, means you get nothing for a set period, say 2 years, and then all the shares vest at once. You can also get them from hitting a performance target, like the company's stock reaching a specific price. When you can sell your shares will also depend on if the company is private or public. If the company is public, you can usually sell your shares as soon as they vest. However, if your company is private, selling can get a little trickier. You often need to wait for a liquidity event like an IPO or acquisition. Or, if your company approves it, you can be allowed to find a third-party buyer to sell to. Now, let's look at how RSUs are taxed. There are 2 tax moments you need to know about. The first is when they vest. The market value of vested shares is taxed just like regular income. That means it'll show up on your W-2 and could potentially bump you into a higher tax bracket for that year. Your company is required to withhold 22 to 37% for federal taxes, but depending on your tax bracket, that might not be enough. You might need to adjust payroll withholdings or make estimated tax payments to avoid a surprise bill. Some companies also offer a sell to cover option, allowing you to sell a portion of your shares immediately to cover your taxes. And if you want to minimize that long-term tax burden, you can also use that influx of cash flow to fund retirement accounts like IRAs or 401ks, in addition to what you were already doing. That can help reduce your overall tax burden while still supporting your financial plan. The second moment is when you sell. If you hold the shares and then later sell them at a higher price, you'll owe capital gains tax on the difference. The timing of when you sell will determine if you'll pay short or long-term capital gains rates. So, if you do plan to hold, you'll want to be strategic about the time frame. And this goes both ways. Sometimes if the stock goes down after it vests and you hold it, you can capitalize on a loss and harvest that loss to use against gains elsewhere. One way to ensure you can avoid capital gains issues altogether is to just think about selling upon vesting every single time. Remember that vesting date and sell on that date. That way, the tax that you have to pay is simply income tax, and there's no additional complications of short-term gains, long-term gains, or losses along the way. Another thing to think about when you're looking at your unvested RSUs is that the value of that stock is not necessarily what you're going to see. As we talked about, sometimes companies will automatically withhold taxes in the form of that stock before it vests. So when you see 100 shares of unvested stock, you might only receive about 75 of those shares at the end of the day. So the value that you're looking at on your online statement might be a little different from what you actually see translated into your account down the road. This can oftentimes be a confusing point for clients that think they have a certain amount of money in unvested stock, but then when it comes and taxes are taken out, it's a completely different figure. The third thing to consider is how you sell. Sometimes it's appropriate for clients to generate additional income from the sale of stock by using option strategies like selling call options. This is a little complex, so we'll dive into this in next week's video. Now let's talk about something that we see all the time from clients: over-concentration in their company stock. RSUs can be a great tool for building wealth, but it's a huge risk to you, especially if you have, say, 50% of your portfolio hinging on a single company and the performance of that stock, especially when your salary is also dependent on that company. Think of cases like Enron, where employees with concentrated positions lost both their jobs and their life savings when the company went under. You want your portfolio to be diversified in a way that smooths out potential negative volatility. It's also important to stay objective about what you're invested in, and within the company, how well it's doing. A lot of times we see clients that have an emotional attachment to their company stock out of loyalty. And while that's understandable, at the end of the day, your reasons for holding the stock should be the same as if you had any other position. You should ask yourself, do the company's fundamentals justify holding the stock? If the answer is yes, then great. If not, then maybe it's time to look at strategies to divest away from it and into opportunities that'll be better for your long-term financial security. You should also consider ways in which your RSUs can help you achieve your longer-term financial goals. In some cases, it makes sense to sell your RSUs as soon as they vest if you're looking, for example, to buy a house, send a kid to college, or pay off high-interest debt. RSUs can be a great way to generate cash without tapping into other assets. Many times we find with clients that selling upon vesting is the best strategy to maintain a target allocation to the company stock that they're working for, while also continuing to save and fund a diversified portfolio that can grow along the way as well, but in a much smoother way with less risk or volatility. Let's wrap this up with a few key takeaways. 1. Understand your RSUs. Know your vesting schedule and restrictions before making any decisions. 2. Consider your taxes. RSUs may actually be taxed twice, once as ordinary income when they vest, and again on any gains when you sell. Plan ahead to avoid any surprises. 3. Avoid overconcentration. Limit how much of your net worth is tied to your company's stock to reduce risk and volatility. 4. Determine a strategy. Decide ahead of time whether you'll hold, reinvest into tax-advantaged accounts, or diversify into other investments. 5. Align your strategy with your financial goals. Treat RSUs as a part of your overall financial plan, whether that means funding short-term needs or building long-term wealth. Overall, RSUs can be an incredible tool for building wealth, but it's important to be strategic. Know when you can sell, understand the tax implications, and avoid letting too much of your wealth depend on one company and its performance. Most importantly, make sure your decisions align with your broader financial goals, whether that's paying down debt, building a diversified portfolio, or saving for retirement. I'm Justin Kuntz, Managing Director of Pacific Wealth Management, and if you're interested in seeing how we help our clients at Pacific Wealth get the most out of life with their money, be sure to visit us at www.pacwealth.com. Thanks.